Welcome to the Deep Dive, where we cut through the noise of corporate reports to bring you the core insights that truly matter. Today, we're doing a full deep dive into Sonoco's second quarter 2025 performance. This isn't just about numbers, it's a crucial look at how a major player in the global packaging industry is aggressively reshaping its business in a volatile market. We'll be extracting the most important nuggets of knowledge from their recent earnings call.
Exactly. Our mission today is to unpack everything from their headline financial results to major strategic divestitures and exciting future growth areas. You'll understand not just what figures moved, but why those movements are pivotal for Sonoco's long-term trajectory and, what they signal for the broader markets about getting well-informed fast.
Okay, let's jump right into the big picture then for Sonoco's second quarter of 2025. The company reported strong top and bottom line growth coupled with notable margin expansion. On the surface, it looks like a really powerful quarter.
It truly was a transformative quarter, yeah. Reinforcing this idea of a new Sonoco emerging, net sales surged by an incredible 49% to $1.9 billion, which is just a massive leap. And adjusted EBITDA wasn't far behind, up an impressive 25% to $328 million. What's maybe even more compelling is that their adjusted EBITDA margin expanded by a full 100 basis points, hitting 17.2%. Adjusted earnings also saw a healthy 7% bump, even with some higher than anticipated interest expenses. So adjusted EPS landed at $1.37, another 7% increase year over year. These aren't just figures, they're a testament to a company actively in transition, making bold strategic moves, even as it navigates these persistent global macroeconomic pressures.
Right. You mentioned this idea of the new Sonoco. How did management characterize these results, and what were the main sort of tailwinds and headwinds they identified?
Yeah, they unequivocally framed their second quarter results as reflecting the growing strength of the new Sonoco, driven by that strong growth and impressive margin expansion we just talked about. That 7% growth in adjusted EPS, for instance, it came primarily from a $20 million benefit due to favorable price-cost dynamics within their industrial businesses. And on top of that, there was an additional $15 million gain from strong productivity improvements, particularly in their S&P US and industrial segments. It shows they're not just growing, but growing more efficiently.
But every story has its challenges.
Right.
What were some of the speed bumps they hit this quarter?
Absolutely. While strong, their results did acknowledge impacts from broader global macroeconomic pressures, which are affecting both consumer and industrial demand in certain areas. Plus, there was a specific, somewhat unexpected challenge: a 3-week delay in the European vegetable packing season. And what partially offset those productivity gains and price-cost benefits, leading to slightly higher interest expenses, was about 7 cents more than they anticipated. This was due to pulled forward amortization fees related to a term loan payoff. Basically, they paid down a loan early, incurring a one-time charge, and increased commercial paper balances, which are those short-term loans used to manage immediate cash needs. It's a good example of how even strong quarters can have these sort of granular financial complexities.
Okay, yeah, that's a comprehensive look at the overall picture. Now let's peel back the layers a bit and examine how these strategic shifts are playing out across their key business segments. Where should we start to see the biggest impact of this new Sonoco?
Right. The consumer packaging segment is really where the transformational impact shines through, I think. This includes their U.S. metal business and the newly acquired SNP AMIA, which is their substantial European food packaging operation. This segment was an absolute growth engine, witnessing a remarkable 110% increase in sales and an even more impressive 115% surge in adjusted EBITDA year over year. Now, a huge portion of that was, of course, propelled by the SNP AMIA acquisition, but even their domestic metal packaging business contributed with a solid 10% gain in volume and mix, achieving double-digit growth. This tells you they're seeing strength not just from M&A, but from the core operations too.
Wow, that's a phenomenal surge in consumer packaging. Did we see similar trends in the industrial segment, or is it a different story there?
Shifting gears to the industrial segment, it told a very compelling story of robust profitability, even with, slight top-line pressure. Sales decreased modestly by 2% to $588 million, influenced by lower volumes and their strategic exit from the China market. However, this was partially offset by better pricing, which is key, right? What's truly impressive here is that adjusted EBITDA in this segment actually grew by 16% to $113 million, and margins expanded by an outstanding 290 basis points to 19%. This marks their 7th consecutive quarter of margin improvements. 7 quarters.
7 quarters, yeah.
That's remarkable consistency, especially in a segment facing some volume declines. It speaks volumes about their mastery of cost control and operational discipline, attributed largely to a favorable price-cost environment and strong productivity.
7 quarters of margin improvement is genuinely impressive. Okay, what about the all other business? Is it as straightforward?
The all-other segment, which encompasses ThermoSafe, their temperature-assured business specializing in sensitive cargo and plastic industrial, reported flat sales at $95 million. While ThermoSafe did see higher volumes, it was unfortunately offset by weakness in their plastic industrial business. Adjusted EBITDA for this segment actually declined by 8%, mainly due to an unfavorable mix and price-cost dynamics, though productivity gains did help mitigate some of that impact. This segment clearly highlights the areas they're looking to, well, divest.
Yeah, that brings us nicely to their ongoing transformation journey. Sonoco has been quite vocal about reshaping their entire portfolio to really focus on value-added metal and fiber packaging. What's the strategic thinking behind this massive shift?
It's all about competitive advantage, really. Their strategy is deeply rooted in leveraging advanced material science and technology where they can truly differentiate themselves. They're focusing on products with high functionality, where they can command better pricing, and relentlessly pursuing continuous process improvements for productivity. Think about it. They are concentrating on just 3 core businesses now: metal packaging, rigid paper containers, and industrial paper packaging. In these areas, they're not just participating, they're aiming for market leadership. It's a disciplined approach to shedding assets to achieve a more focused, high-margin future.
And part of that focus clearly involves significant asset divestitures and aggressive debt reduction, right?
Absolutely. This isn't just talk, they're executing. They've already successfully divested their thermo-formed and flexible packaging business, or PFP, which focused on lighter plastic packaging solutions. And they explicitly plan to sell ThermoSafe, that temperature-assured business we just mentioned, in the second half of the year. The proceeds from these sales are strategically earmarked for debt reduction, which is critical for their financial health. Their net leverage ratio was already below 3.8 times, and they've set an aggressive target of 3 to 3.3 times by the end of 2026.
Wow.
So this streamlined structure isn't just about focus, it's about financial strength. They've already actioned about $20 million in annual savings from what they call stranded costs related to divested businesses, and they're actively working on further optimizing their operating footprint.
Okay. A major part of this transformation, and frankly the Q2 story, was the SNP AMIA acquisition. How is that integration progressing, and what were the key challenges they faced there?
The integration of SNP AMIA, their substantial European food packaging operation, is progressing quite well, according to management. They're projecting between $40 million and $50 million in run rate synergies from this acquisition by the end of 2025. And they have a clear line of sight to achieving over $100 million in total cost savings through 2026. However, it wasn't without its bumps. Significant procurement synergies, for example, were delayed to 2026 due to the late closing of the acquisition, which is, a pretty common integration challenge.
Right. So beyond the integration timeline, what were the main headwinds impacting SNP AMIA's performance in the second quarter specifically?
Yeah, the second quarter results for SNP AMIA were certainly impacted by that 3-week delay in the European vegetable packaging season. This might sound minor, but that season accounts for about 40% of their AMIA sales, so a delay has a real ripple effect. Beyond that, difficult macroeconomic conditions across Europe also slowed consumer demand. And here's one of those unexpected, almost quirky details from the call. A decline in sardine availability in Africa actually further reduced volumes.
Sardine availability. Really?
Yeah, sardine availability, that's one of those granular details from an earnings call that really hits home the unexpected global interconnectedness, isn't it? It's not just big macro trends, but literally what's swimming in the ocean that can impact a company's bottom line. It keeps you on your toes. Despite these challenges, it's worth noting that demand for pet food and certain premium food categories within AMIA remained remarkably resilient.
That's fascinating about the sardines. Looking ahead, what's the outlook for SNP AMIA, especially with the harvest season ramping up? And are there new growth opportunities emerging?
The outlook is definitely more optimistic. For the third quarter, which is historically their strongest due to the harvest, the season is ramping up, and both customers and external experts are predicting a solid European vegetable harvest, possibly extending right through October. The team is actually expecting mid to upper single-digit organic volume increases year over year for the third quarter, with July apparently starting strong. Despite the Q2 challenges, crucially, there's been no material loss of market share, which is a key point of confidence.
Good sign.
Yeah. And on the growth front, Sonoco announced some truly exciting new projects for AMIA, including a multi-year contract with an Eastern European pet food customer for up to 400 million incremental units annually. That's huge.
Wow.
Plus, a new 5-year contract for unique shaped cans for powdered nutrition set to begin in late 2026. Oh, and on a management note, Roger Fuller was also named interim CEO of SNP AMIA following the passing of Thomas Lopez, which shows, continuity and leadership during this integration.
Okay. Beyond acquisitions, Sonoco also emphasized their commitment to investing in themselves in capital projects and productivity improvements to drive profitable growth. What are some of the key investments they're making there?
They've truly put their money where their mouth is, yeah.
Yeah.
Investing $188 million in capital during the first half of 2025, and they anticipate total spending to be around $360 million by year-end. One standout project is a $30 million investment to expand production capacity for the U.S. adhesives and sealants market, adding 100 million units annually across 3 facilities. Apparently, they're currently sold out in that area, so this is a direct response to just robust demand.
Makes sense.
They're also expanding robotic assembly for nailed wood reels in Alabama. That's a business where Sonoco is the U.S. leader to meet heavy demand from expanding domestic energy and communications infrastructure. So these are targeted investments in high-growth, high-demand areas. Overall, they're not just spending. They're strategically investing and targeting $65 million in productivity savings for 2025 through automation and other efficiency improvements. It shows a disciplined approach to self-improvement.
And what about the growth outlook specifically for their existing consumer packaging businesses, like their U.S. metal business?
Right. Their S&P U.S. business is projecting a healthy 12-15% growth in food and aerosol cans for the year, driven by both new and existing customers. On the sustainability front, their global rigid paper container business continues to launch innovative new all-paper and paper-bottom cans for sustainability-focused customers. They highlighted 2 new all-paper cans for pet nutrition in Europe in Q2 as examples. This is a clear indicator of market-leading innovation. It's also worth noting that Sonoco recently received 3 industry awards for sustainable packaging, which, underscores the recognition of their metal and fiber-based products in a world increasingly focused on eco-friendly solutions.
Right. So with all these moving pieces, the acquisitions, the divestitures, the investments, how's Sonoco's new CFO, Paul Jock, guiding the ship for the full year? What's the latest on their full year guidance?
Yeah. Paul Jock confirmed that Sonoco is maintaining its full-year net sales guidance in the range of $7.75 billion to $8 billion, and their adjusted EBITDA guidance of $1.3 billion to $1.4 billion. They still expect continued strength from their North American consumer and industrial businesses, but this will be partially offset by the softness we discussed in Europe and other international markets. Also, ongoing delays in recovering rising input costs and some tariff uncertainty. For adjusted EPS, they're now targeting the low end of their previous range, which is $6 to $6.20. This adjustment is primarily due to the higher interest expense they experienced in the first half of the year, despite an expectation for improved interest costs in the second half. Operating cash flows are also targeting the lower end of their range, largely due to higher than anticipated net working capital usage, mainly from material inflation. It really highlights the ongoing challenge of managing working capital in an inflationary environment.
Okay. And what are the key sensitivities that could impact that full year guidance? What should we be watching?
Management highlighted a couple of key sensitivities. Firstly, for every $10 movement in URB, that's uncoated recycled board pricing, that translates to approximately a $6 million annualized benefit. And they expect a healthy benefit to kick in during Q3. So URB prices are a big lever. On the FX front, the currency exchange, they expect the euro to trade between $1.17 and 1.18 against the US dollar for the second half of the year. That's already baked into their current guidance. However, for every 1 cent movement in the euro USD exchange rate, they anticipate about a 2.5 cent impact on EPS on an annualized basis.
Okay.
Finally, their full year tax rate is expected to remain around 25%. So those are the important dials to watch.
All right. So we've walked through the numbers, the segments, the strategy. What does this all mean for you, the informed investor, trying to piece together Sonoco's story?
Yeah, I think this deep dive clearly reveals a company undergoing a significant and pretty determined portfolio simplification. They are aggressively shedding non-core assets to double down on what they've identified as their most competitive and profitable businesses. That's metal and fiber packaging. The stark regional divergence in performance, that robust growth in North America versus the continued softness in Europe, highlights just how crucial geographical exposure is in the current global macroeconomic climate. Their proactive capital investments in areas like U.S. adhesives and those heavy-duty cable reels signal confident bets on structural growth trends that align with broader infrastructure buildouts. So for you listening, this means watching how effectively they capture those remaining synergies from the AMIA acquisition, how they manage these persistent inflationary pressures on working capital, and how swiftly they continue to deleverage, especially with the upcoming ThermoSafe sale. It's a clear signal of management adapting to a new, leaner operating model, really poised for long-term value creation.
Okay, excellent summary. All right, it's time for our This Is Not Financial Advice segment, where we pitch an outrageous but plausible trade idea, just like a hedge fund analyst might, to an investment committee. It's a bit of fun, but it gets you thinking.
Okay, given Sonoco's recent earnings call, here's a thought for a tactical pair trade on the global packaging sector. You would go long companies with significant exposure to the U.S. industrial and infrastructure build-out, especially those with strong pricing power and domestic raw material supply chains. Think about the robust demand Sonoco highlighted in U.S. adhesives and sealants, and the wire and cable reels business benefiting directly from domestic energy and communications infrastructure expansion. This segment is showing consistent margin expansion and a proven ability to pass on costs, making it, a potentially powerful play on a strong underlying trend in the U.S. economy.
Interesting. And what's the other side of that daring trade, the short?
Concurrently, you would go short or underweight European-focused packaging companies, particularly those heavily reliant on seasonal agricultural products or with significant exposure to niche industries like, sardine fishing, especially if they lack broad geographical diversification. Sonoco's SNP AMIA segment specifically called out those painful delays in the European vegetable harvest season, the difficult macroeconomic conditions impacting consumer demand across Europe, and even that granular detail about the decline in sardine availability in Africa.
Right, the sardines again.
Exactly. All of these factors demonstrably weighed on volumes and margins for them. So the idea here is to capitalize on the clear divergence in regional economic health and specific industry headwinds, using Sonoco's commentary as a kind of bellwether for those broader trends. It's a bold play on both macro and micro factors for sure, but Sonoco's call really laid out the pieces for this particular thesis.
All right. That wraps up our deep dive into Sonoco's Q2 2025 earnings call. We saw a company demonstrating genuinely strong financial performance despite those external headwinds, driven by aggressive strategic portfolio shifts, disciplined synergy capture, and targeted capital investments. It's quite a compelling blueprint for how a large company can transform itself.
Indeed. It's a compelling narrative of adaptation and intense focus. I think the key takeaway for you, our listener, is to consider how Sonoco's disciplined approach to cost control, leverage reduction, and strategic investment in what they see as high-growth, core businesses positions it for long-term value creation, even in this uncertain global environment. The big question moving forward is really, how will their newly simplified, more agile structure translate into sustained operational excellence and market leadership in the years to come?
We hope this deep dive provided you with valuable insights and perhaps even a few aha moments. We appreciate you joining us for this crucial earnings analysis.